Hi guys, welcome to Investing with JYK, and today we'll discuss a um, company Hasbro that basically builds toys. So as you can see on Hasbro's website, they've got a bunch of brands. Some worth noting. Well, actually, I don't know too much about toys, but I recognize the Disney ones. There's one, two, three, bunch here. And you also have Marvel, you have Monopoly, Nerf, Play-doh, and Star Wars. Okay, so you can see there are a lot of uh, recognized names. So that's their business. Basically, they just build these. They just build some toys and build some board games and whatnot. And you can see that their age groups typically, actually, they focus on very low age ones. So if you look at, 18 plus, there's 207, and then there's a lot between 13 and 18, and 600 for. This is interesting. So there's 332 for 13 to 18, 663 for 8 to 18. Okay, I guess there's some overlap here. But you can see most of their stuff is actually suitable for kids from 0 to 10. Okay, so having seen this, let's look at their filings. One part is that most of their revenue actually comes from US and Canada, and then international accounts for less than half. But that's just the revenue. If you look at operating profit, US and Canada is more than 2/3. It's about 2/3 of the total profit. So generally, international is just less profitable. I think the gross margin is much lower. The price, essentially, they're selling the toys at a lower price. Okay, so remember these sectors that they talk about. They actually put them into two segments. You can see it somewhere here. Yeah, you got the franchise brands and you got the partner brands. Franchise brands are the brands that Hasbro owns. So they have some growth, and then essentially it's 50% of their total revenue. And partner brands are brands that are owned by other companies, in this case, mostly Disney. And you can see a lot of the things like Marvel, Spider-Man, Avengers, Star Wars, Disney Princess, Disney Frozen, all these things are basically Disney. And except, I guess, Sesame Street. I think DreamWorks is also bought out by Disney. So yeah, so majority, so this thing I checked later, this account for 24% of their revenue. And the difference between those two is obviously if you own the actual brand, you don't pay anyone for the IP. But on the other hand, if you have to use someone else's IP, you have to pay a royalty. And in Hasbro's case, there is a floor for the royalty. So basically, if they don't sell a certain amount of toys, they still have to pay that floor amount. So that is like a fixed cost, and then that will it's essentially that makes them more leveraged in a sense. And then they have this Hasbro gaming stuff. So this stuff is their mobile games, and then I checked out their mobile games built by this Backflip studio. So you can see they, at least on Google Play, they have these games. They seem to be somewhat similar in style, but you can see it's an editor's choice, so they're doing pretty well. The number of reviews is 280K, so that we'll check how big this is, but this is not the number of downloads, right? Assuming the ratio of review to downloads is approximately the same, we can check, Dragonville is 350K, and then this thing is 50K, 60K. They're mostly all editor's choices. Ninjump is 400 something, right? And then and this guy is 400, and so around there, 100,000, around 100,000, between 100,000 to less than a million is what they have. So how does that compare to other things? Let's see, say Star Wars, right? What is that? 1.4 million. And then if we look at things like, I don't know what this, what's your story? Clash Royale, so Supercell stuff, 21 million reviews. So that is a hit. That's what we call hit. And by that standard, the Backflip Studios, which is owned by Hasbro, they're only one. None of them are like big hits. Even Angry Bird 2, 3.5 million reviews. And if you look at things like, I don't know, maybe Dragon Ball Z, I have no idea, 600,000. Right, so they don't have like super blowout hits, but they have some games, but definitely it's not their strength. So I wouldn't place too much of an emphasis on their mobile gaming segment just yet. If they grow a lot in the future, maybe, but at the moment, meh. And then they talk about they have some other brands that are emerging brands, basically the brands that haven't taken off yet. Okay, so haven't seen this. Let's look at their numbers. I had a thing around here. So these are their 20-year revenue, net income, and ROA, ROE, and ROIC numbers. You see some really weird stuff in 2000, around the 2000, and then really weird thing at 2017. So let's try to understand what actually happened, right? So in 2000 and around 2000, they got, you can see, I mean, this is understandable. They got the first dip is more or less understandable. They have a revenue dip, right, to 2001. So, okay, so maybe revenue dip explains the first dip. This almost looks like an ass, but okay. The second dip is actually to do with the what do you call those? The accounting rules. So there was so this one, the statement number 142 from Financial Accounting Standards Board, the one that defines GAAP, says they will change the way they deal with intangibles. So that happened in 2000 and around here. So that probably explained this. So since then, the earning basically normalized in 2003, and then you see a fairly steady growth going from about $1 billion to the almost $5 billion until the recent drop to $4 billion. Well, actually, that's a $6 billion to $4 billion. So you're like, okay, so what happened in 2017? So I dug a little bit into the number as well. So if you look at consolidated statement of operations, I'm sorry. Yeah, around here. So you can see the revenue still increased, though not a lot, but there's an increase. The cost of sales increased a little bit. And if you keep going down, you can see that the operating profit increased. So basically, that's like everything other than taxes and interest. And you can see the interest is, so this is EBIT basically. And then the interest, there's a little bit of change, but not too much. But then you have this other expense. So we don't quite know what that other expense is, but that's still not a large number. And if you look at here, you can see the earning before income taxes. Earning before taxes is fairly high, but the tax is suddenly really high. So that has something to do with the recent tax change, the tax law that was passed in the late of 2017, where Trump made, there was essentially like a repatriation holiday. Remember, a lot of the revenue for Hasbro comes from international sales, right? So that money essentially got repatriated, and they suddenly have to pay a huge amount of tax on that, even though it's like at a discounted rate. So I try to normalize for that. So assuming, in terms of like the underlying earning power, how much their earning will be if the tax rate remain relatively stable. So that number comes around in here. So basically, just put the numbers in from their statement, and then this is the amount of tax. So you can see the tax rate became like 50%, which is a lot higher than the actual tax rate, the normal tax rate. That's because they repatriated a lot of dollars back, and these are essentially money made in the past, and now they suddenly pay the tax like this year. And so the diluted EPS, as they stated, was 3.12. And based on those, I calculated the share count, which is 175 million, I think. Yeah, I think that's million. These are in thousand. Sorry, 1,000. Right. So 127 million basically. So this is in thousands. And then the new tax rate, the new corporate tax rate is 21%, right? So based on that, we can compute how much their after-tax earning would have been if there wasn't this one-time repatriation tax cost. So that's how much it would be, and then the normalized earning, the normalized EPS would be something 4.8. So this graph here really is a bit misleading. In fact, it should go up a little bit more. Where are we? We are at, whoops. So instead of 5.3 billion, this should really be 6.2 billion. So this thing should really go up like somewhere here instead of here. Okay, so that means the current number for Hasbro is misleading, especially anything to do with earning. So EV to EBITDA obviously is not going to change because we excluded IT, so the tax here. So that's still going to be correct. And EV, anything to do with sales, that's still going to be correct. PE is going to be very skewed because what they were using to calculate the PE is the diluted EPS, which is 3.12, right? So if you look at the price is 82.81, you divide that by the PE, it's 26.54, you get 3.12. So if you use the normalized number, you should get 4.88, so 4.8857. So if you do 4.8857, you get 4.88. Yeah, so actual PE is going to be around 17. So that doesn't look very expensive. So their growth last year was somewhere around, in terms of earning before taxes, that's gonna be something like 786 divided by 6, oops, 692,489, like 10%, 13%. Let's say 10%. So a large company with a huge portfolio of brands that are recognized, selling at 17 times earnings with about a 10% growth. I think I would say Hasbro is fairly valued. Obviously, they're not undervalued. If they're selling at 10 PE, then yeah, this is a great deal. So at 17, they're an okay deal. But if you look at like PB and especially tangible book, it's fairly high. So you probably can't expect them to sell. If they do go bankrupt, you probably can't get much money out. But this company is very unlikely to get to go bankrupt. People, I mean, kids still play toys and are new kids all the time. And return on asset is 7%, reasonable. Return on equity is 21, so you're looking at close to 3-to-1 leverage. So that is something that you have to keep in mind. They have a decent amount of debt. You can see the debt to equity is actually 101%. Right, so you got about, but in this case, they have $1 billion in cash and 1.6 billion in cash and 1.84 billion in debt. So I would say it's reasonable. The other thing is dividend is 3%. So I would say that's fairly decent. So in the current market, which is in general fairly overvalued, why is Hasbro selling at seemingly reasonable valuations? And if you look at their stock price performance, it hasn't done very well. Since, I mean, 2017, the overall market went up like 23% or something. So what is going on? I think the majority of the this drop is probably just Toys R Us. They may not be able to collect a lot of credit that they potentially have extended to Toys R Us, and that would be reflected in the in here, account receivable. So in end of 2017, their account receivable is 1 billion. That's $1.4 billion, and we don't know how much of that is exposed to Toys R Us, and if it is, best case it will get all the money back, but with a significant delay. Worst case, it will lose a lot of that. I was not able to find out how much exposure they have to Toys R Us. But you can see this is quite significant, right? $1.4 billion in account receivable. In the same time, their revenue is just $5.2 billion. So if you compute the ratio, 1,405, 399 divided by 5,209, 782. So that's like close to 25%, 27% times 365 days. You're looking at 100 days, about 100 days to collect their bill. Is that high? It's not really high. 90 days is the standard, I would call, for their business. But certainly, if it's lower, they would have had less exposure to Toys R Us, for example, in this case. Okay, and the other thing that we must understand is they spend a lot of money on marketing. Last year, they spent about $0.5 billion. I don't remember where I read it, but it's in their 10K, about $0.5 billion in marketing. So that is basically 10% of revenue. So 10% revenue goes to marketing, and then their royalties as another close to 10%. Right? So R&D itself is much lower. So yeah, here advertising is 5 billion. Is 500 million. So you gotta the R&D, royalty, and advertising is more than $1 billion. And then you got the distribution, which is another $1 billion. So you can see that the how much royalty costs in this case, right? So as I mentioned before, if you don't own the IP, you gotta pay a lot for it. But it's still they're still a very profitable business. So keep that in perspective. Okay, so in terms of future projection, I'm thinking, who's gonna play their games and toys? As we discovered, mostly it's gonna be kids between 0 and 10, and so how many of these kids are there? As we figured out, the majority of the profit comes from US and Canada. So here is US's population distribution, essentially. So you can see the boomers around here. Obviously, this quickly drops off. That's because people just die. And you can see here is a bump around 25. I talked about this in the LGIH video as well. So that's the demographic trend. You got this bump here. Now, if you look at the distance between these two peaks, you can see it's about 30. So what does that tell us? That basically just means people have kids at around 30 years. Here have most amount of kids around 30 years old. So it's almost like an echo 30 years later. And that tells us there should be another echo here coming soon if people keep their fertility rate. And this is another graph that is it's grouped by 5 years. You can see the same thing. You got the bump in this age group, and you got a bump in this age group. So I am expecting some kind of bump again coming soon. So next 5 years, that demographic group should account for around 3.5% instead of just 3.1% of the population. So that's US. If you look at Canada, Canada looks somewhat worse because their echo is smaller than their boomers, right? You can see this is 3.5 versus 3.8. In US, it was 3.4 and 3.6 actually for the male. Female male is usually about the same, except if you go further down, there are more old females because females live longer. Males by like 50 years old, you can already detect they started dying. And actually, you can see it from here, yeah? The surplus, the male surplus kind of disappears around 40, 30, 35, 40. So that's when there's enough male death to account for the initial surplus. And from that point on, it's just female. They're just more female than male. Okay, so Canada, I'm thinking, looking at this trend, they seem to be having fewer and fewer kids, basically. So the next echo should be coming as well. That's a 30-year echo, and then that, you may go to something like 3.2. So Canada is definitely shrinking in terms of young population, the Hasbro's target. But US seems to be doing just fine. And fertility rate, you can see it used to be crazy high in the 1960s. So those produced the boomers. That was the end of the boomer period. And the fertility rate went up again in 1990s. So that's when the boomers themselves started having babies, and it dropped off again up to now. So I'm expecting a slight uptick again, simply because the group of people, the millennials, are now, which has been, from this number just zero fertility, will start having babies, and then that will drive that number up. But there's one big threat. So more and more kids now don't play with actual physical toys, but with mobile phones or iPads. So Hasbro does have that to worry. Their entrance to mobile gaming, which is this Backflip Studios, doesn't seem to be doing fantastic. They're doing okay, but they don't seem to be, making any hits in mobile gaming. So I don't really know if the kids will play the same amount of physical toys as they used to. But on the other hand, emerging markets might. There's actually two things to do with emerging markets. One is, as emerging markets, especially China and India, they get more money, the kids will start playing with better toys. On the other side is, when I grew up, for example, nobody cared about who actually owned the IP. There was no respect for intellectual property. People just copied anything, and there was no enforcement. And that is changing. So that should be a good thing for Hasbro. Okay, so to conclude, I think Hasbro is a company with a fairly good moat, though it might be eroding. The moat is constructed around brands, and a lot of these brands have recognition, and they have been, time tested. They have a good relationship with character producers such as Disney and some others. I forgot which ones were, but they have some good relationships. So, and then they were able to keep that. Their entrance to mobile gaming isn't a huge success, and currently they're selling at reasonable PEs. At 17, you're looking at so 1 divided by 17, you're looking at like 6% return, and it's a 6% return that seems to be growing at around 10%. So factor in a recession, whatnot, you might be looking at even 6, 7%, 5% of growth. It's a reasonable price to pay. They also give you a reasonable amount of dividend at 3% currently. So if you want to buy a company that hold it for 10 years or more, I think Hasbro at the moment is a reasonable choice. It's not a fantastic play, but I do think it will outperform quite a few other companies. For example, let's say just McDonald's, right? McDonald's is selling at 25 PE, and it doesn't necessarily have the same. It has probably even less growth than Hasbro. And in terms of demographics, we have one thing that's going for Hasbro, which is the um, increase, which is basically millennials having babies, and one thing going against it, which is new babies don't seem to play too much with toys. So yeah, you have to make your own choice, and this is how much I have dug into Hasbro. Thank you very much, and if you have some comments, some suggestions, please leave them below in the comment section. And if you like what I do, please click like and subscribe. See you next time.